Welcome to The Sound of Economics, the podcast series by Bruegel, the Brussels-based economic think tank. I am Yuyun Zhan, host of our monthly podcast, Zhonghua Mundus, that brings you recent updates about Chinese economy. As usual, I am with our senior fellow, Alicia Garcia Herrero, also chief economist of Natixis. She is joining us from Taipei today. Hi, Alicia. How are you doing?
Hello, Yuyun. How are you?
Good, thank you. Joining us also from Beijing today is Jens Eskeland, president of European Union Chamber of Commerce in China. Jens, welcome to The Sound of Economics.
Thanks for having me.
For decades, investors worldwide have been captivated by the allure of China's dynamic economy and burgeoning opportunities. With its remarkable economic growth, vast consumer market, and technological powers, China has emerged as a focal point for global investment. However, navigating the complexities of the Chinese market presents unique challenges, from regulatory uncertainties to geopolitical tensions, not to even mention the huge disruption brought by COVID, which we will delve into later. In this podcast today, we want to talk about the factors driving investors' interest in China, explore investment opportunities across various sectors, examine the risks and challenges involved, and gain insights from experts to navigate this ever-evolving landscape. Jens, sitting from Beijing, you are on the front seat of doing business in China, so there are still a lot of appeal to investing there. Could you perhaps elaborate on specific sectors or industries in China that are particularly attractive to investors?
You're absolutely right. There's still interest in investing in China, but one of the shifts that we have seen is that China is beginning to get a little bit of competition for many reasons. We are seeing locations in Southeast Asia, but also in India and elsewhere, beginning to become attractive from investor point of view. So you can say one thing that has happened is that China does not, to the same extent as it has some years ago, have a near monopoly on European investor interests. There are different drivers from that sort of shift in sentiments, and I think it would be a mistake to try to sort of try to paint every industry or every company by the same brush. I think you can perhaps broadly place industries in 5 different buckets. One of the industries where we continue to see very strong interest in China is amongst the big multinationals, and perhaps in particular within industries such as automotive. You can also take my own industry in my day job in shipping and logistics. You cannot be a leading logistics and shipping company if you do not have a significant presence in China. So you will have a significant number of multinational companies for whom China is an existential market due to the size of the market and its position in global value chains. Then you also have, for example, within automotive, where China today is a leader in many aspects, not just sort of the battery EV aspects of it, but also when it comes to systems, the software and so on. So if you want to be at the real forefront of where technological development takes place in that industry, you also need to be here. But that's very much the MNCs, the multinationals, where we see them actually in some cases doubling down on investment in China. Then we have a second category of companies that are perhaps to a larger extent seeking to ring-fence their supply chains, maybe bringing more of their supply chains onshore in China, and their non-Chinese manufacturing, isolating them from China. So you begin to develop separate supply chains. That could, for example, be within the digital space, within data, within textiles, and so on. Then you have a third group, and that's a development that has been underway for at least 5 years. The talk about China plus one, where for tariff reasons or whatever other reasons that companies, and that includes Chinese companies, by the way, begin to invest outside of China to try to avoid some of these restrictions that are sometimes imposed on trade. Typically, that could be industries such as consumer electronics, appliances, white goods, and so on. And then you have a fourth group, which I think is problematic from a European perspective, and that's the small and medium-sized enterprises. A lot of SMEs are now beginning to feel that maybe China is a little bit risky. And, if you are facing a possibility that over time, maybe you would have to develop for geopolitical or other reasons, a China-specific supply chain and a non-China supply chain. For some SMEs, that will simply be a project too large. They will not have the capital, they will not sort of have the bandwidth from a human resources perspective to maintain two separate supply chains. And then maybe the question becomes, if it is that difficult in China, even if China is attractive in many ways, I better go for Vietnam or other places. And then, of course, you have a fifth group, which is not very large, but still a group of companies who decides that China is simply not for them anymore because it is becoming too restrictive. That is, for example, into technologically sensitive industries, digital platforms, and high tech, where companies may be forced also from drivers by overseas governments to say, it's either China or somewhere else. And in this case, my main markets are outside of China, so I'm going to leave. So I would say these are sort of the five broad categories, and some of the drivers also that we see investments into China beginning to spread a little bit more around the regions.
Thank you very much, Jens, for providing this complex picture of how foreign business are feeling about investing in China. It's very good that you brought this kind of shift from European companies' interest in China. On top of that, I wanted to ask Alicia, it has been more than 1 year since China's reopening after the COVID pandemic. And while it's aiming to recover the economy and deepen its growth, investors seem to not be so confident on this either. According to the latest data, China's foreign investment inflows has fallen 26% in Q1 2024. How could we explain this sharp decline?
This is a very important question, Yuyun, not only for China, but also for investors, European investors as well, because, yes, indeed, as Jens was saying, some companies are really into it. Yeah, we can say that probably the stock of investment, because, what you are referring to, Yuyun, is this is a flow. This is every year's investment. But some companies have been investing in China for years and years and years, and their stock of investment is very high, meaning they may as well think, I am in it no matter what, because it's so important for me. But there are many companies that are starting, especially newcomers or relatively newcomers, to say, you know what, I'm going to repatriate my profits. And that's a lot of what's happening. Before, everybody would reinvest in China, no repatriation whatsoever, because the Chinese market was growing so fast that it would be crazy to repatriate because it was so profitable to keep them. But by the way, repatriation is also costly. You have withholding tax. It is not that it is free, but you repatriate if you think that your expected return is lower and lower and lower. So you may as well, just put it somewhere else, pay dividends to your shareholders, etc. So what is very clear is that, and this is beyond the surveys, that investors do not feel that the future is as bright as in the past, because otherwise they would just not repatriate. And I think this is a big, big issue. The other factor why we see this negative growth is that, yes, those in might want to be in, but we're not measuring in any survey those out, those who should be coming, but are no longer ready to come. And this is, in a way, a bias that every survey has. Yeah, it's like you see who is in, what they want to do, but it's very hard for you to measure what other companies who are not exposed to China are thinking. And what we can tell from that data, which is key, is that not many newcomers. So it's a little bit like a legacy. We can call it a legacy chip. It was really good, but you can already see that it's no longer so much as a repatriation of profits, plus no newcomers. I think that's what explains this number.
If I may just add a little bit on that, Alicia, we have just published a new business confidence survey in the European Chamber of Commerce. And I think you're onto something when you talk about sort of the diminishing returns. 75% of our members actually told us that they're being squeezed on their margins, that they're seeing lower profitability. I think that's a very high proportion, 75%. They're also telling us that 40% of them are losing market share to local competition. 36% of them are telling us now that they are facing overcapacity with a further 10%, expecting overcapacity to emerge in their industry within the next 1 to 2 years. So 50% in reality actually facing overcapacity on top of right now 75% feeling a profit squeeze. And that's, of course, something also that impacts the sort of desire to invest more money into this market right now.
Thanks so much for bringing this up, Jens. It's indeed very bleak numbers that shows a declining confidence in doing business in China, if we might say so.
Well, Jan, if I might just say that, yes, it is bleak numbers, but again, I think it is only as bleak as it is compared to the rest of the world, right? And the thing is, I see when you ask around in many places, it's not a pretty picture generally. And you know, we have even companies who are telling us they're being squeezed on the profits. That, you know, yes, things may be hard in China, but they're actually harder in our other markets, right? So again, I think we also need to see it in sort of contrasting it with the rest of the world to have a picture of, because a lot of these industries are really global in nature and they're moved by world market prices. And they're still, you know, given the production cost, for example, in China, China can still be comparatively attractive to some of these locations.
No, definitely. Like, as you said, like in the world of globalization, nothing is independent, right? And then from the recent number that we see from the outlook given by the IMF, the world economy is not doing so well in general. So then we have to factor in all these kind of considerations. So then coming back to China, in order to boost business confidence, has the Chinese government come up with any proposals to kind of encourage this kind of overseas investment, trying to lure back investors? Alicia, can I start with you?
Well, I would say there is two types of actions. One is indeed, and it's mostly Li Qiang, and you know, very obviously keen, to receive investors, and you know, we had even Xi Jinping, you know, sitting with global company leaders. So you know, I think there is this attempt clearly to bring investors back, because this is important for China. It's not only about the funding. It's actually not about funding. It's about being part of the business innovation, if I may say, not only technological innovation, but because you could buy a company overseas, but it's mostly about your company being in the loop of what's going on in the world. So for that, you need foreign investors. It's very important. So I think they totally get this. And local governments, I'm sure Jens has never been treated as nicely as he's probably treated now in China. I can bet. But the problem is that at the same time, there are things happening in China. We tend to think it's because of we are foreign investors, but maybe they would happen to us even if we were private Chinese companies. You know, it's not really only about us. Sometimes I feel maybe we don't even need to take it personally. It's just something that is happening in China that really goes about, as your wonderful report, Jens, said it so clearly, that, you know, security trumps it all. And the other report you wrote about, because of that, China basically de-risking before everybody even thinks about it, yeah? Because all of these things have consequences on investors. Even, I would say, private investors, let alone foreign investors, because, you know, security, of course, national security is a concept that has a lot to do with foreigners, meaning it's a national security issue. So, you know, you're at the other end of the discussion by definition. So, you know, because of this, I think investors are starting to realize, well, you know, where's my place here? I mean, nationality, or, you know, your origin, or even your private company origin, becomes more relevant than it was before. So I think this is why, even if China wants to do its utmost for foreign investors, there is this kind of unavoidable trend. It's like it washes out any effort they're making. And I think this is why we see this contradiction. It's a real contradiction that is hard to grasp. For me, the contradiction is just about trying, yes, to keep investors, but the big way where China is heading is really about security, about, you know, a vision of the world that is very, you know, protective of its own status quo, put it this way, politically, and I would say even socially, or, you know, value-based, you name it. So I think this is why we have this situation. It's very hard to see measures that break that reality just against the wind. It's just too difficult.
I think you put it very accurately, if I may, Alicia, because I've actually just been on a little bit of a China tour, and just over the past 10 days, I met with the party secretary of Shenzhen and the executive vice mayor of Shenzhen, the mayor of Qingdao, and the executive vice governor of Sichuan province. I mean, when we go out and have meetings locally, they really roll out the red carpet. And there's no doubt about they want to signal to business. They're open, they want to engage, and basically anything that can generate any sort of economic activity is welcome. And the contrast sometimes to Beijing is just so big. So, I mean, sometimes you can be forgiven to you know, when you listen to someone talk about China, you know, does he or she really live in the same reality as I do? But then again, as Alicia also mentioned, I mean, it is a contrast sometimes with Beijing, where sometimes, I have to say, it might even feel a little bit schizophrenic in the way that you have this very, very strong security agenda, draconian regulations being promulgated, like the data security law, national security legislation, and so on and so forth. And then you have things like 13th of August last year, where you had the 24 measures being promulgated by the State Council, which is something we really like if it's being implemented in a meaningful way. And we are, you know, still waiting for that. They have done some of it. For example, some support on the individual income tax side, which was important, and of course the visa-free travel policy for a number of European companies. But there's much more to be done to deliver on that. But I think the thing that really has changed, which is significant, is that, you know, not so many years ago, when we invested in China, you might not like everything in China, but at least you knew what you got. You had a clear line of sight. It was predictable. You would know that tomorrow, in terms of sort of the regulatory environment, will be just like today. Predictability. I think what has happened over the past 3 or 4 years is that there is this feeling that we don't have that clear line of sight anymore. You have a lot of things that just come out of the blue, new regulations, new tightening, things that in significant ways, like the data security law, impacts our ability to do business. We have seen certain industries also being impacted significantly. We saw the way real estate was still dealt with. We have seen sort of the education industry. We have seen other aspects of the tech industry. And there is this growing feeling that, you know, things that we assumed as being true about China might not necessarily be true tomorrow. And if you have an investment horizon of maybe 20, 25, or 30 years, you want to have a clear line of sight. I mean, otherwise, it's a different kind of payback maybe you're looking at. And I think that is one of the main concerns that we are seeing amongst our members right now. That is, you know, what is China really going to look like 5 years from now? And also the bilateral relationship between China and the European Union, or China and the United States for that matter. So a lot more uncertainty. And I think that is a big task of the Chinese government now. That is to go out and explain, and also not just explaining, but also in the way that the government behaves toward companies. I mean, signal that we are stability is about line of sight and predictability. These were some really of the key assets that China had to offer to foreign companies, on top, of course, being a great place to do manufacturing.
And what do you think has prompted this sudden shift from being kind of predictable to new regulations popping up every day, making business find it hard to navigate?
I think obviously a lot of things have been going on. I mean, we have seen geopolitical developments that in some ways are not directly related to business, but are having significant spillovers all to business. We have had, of course, COVID and Russia's invasion of Ukraine that has really made companies ask themselves whether they have become too exposed to a single origin. And there I think maybe in some instances the way that China has responded to these challenges, both the pandemic and Russia's aggression, that is not something that necessarily has given businesses assurances. Then of course you saw at the 14th five-year plan that was launched in 2020, the high focus on self-reliance across broad categories of industry, whether it's energy, it's food or technology. And when governments begin to talk about self-reliance as a foreign company, this is not something that gives us a lot of optimism. And then you had, of course, ASEAN, the 20th Party Congress, also with the high focus again on security, which I think for many of us, we did not feel entirely comfortable about that. But then, of course, 3 months later, we had the National People's Congress, and then Premier Li Keqiang going out and saying that, the government must go out and learn from business, listening to our concerns and see what they can do to improve it. So again, it's always sort of this sort of balance between security and development that I think is at the core right now on some of the concerns many companies have.
Right, indeed. And in a recent Bloomberg interview, Jens, you mentioned that there are already signs of promise fatigue among foreign business, with skepticism over whether meaningful policy support was on the way. Could you elaborate more on that?
Yeah. I think, again, it's this, we have heard now for 45 years about reform and opening up. It's a long time. And we are, again, seeing these sort of political initiatives that seem to pull in the other direction. I think we have then had individual high-profile events that really created hope that then were dashed later on. I think there was this famous speech that President Xi delivered at Davos, I think it was in 17 or 18, where the world sort of was convinced that now something is going to happen, and it didn't. And actually, even when we go back to the third plenary in November 2013, with the talk about making market forces do the allocation of resources, we all thought, hey, this guy's onto something. We are in for a golden period. That was not exactly to happen in that way. And now we have the 24 measures announced in August last year. To be fair, it is still early days, and what we see is that the government is really keen on discussing that, but we think it's really, really important now, if you are to avoid promise fatigue, that the government really prioritizes to deliver, engage in dialogue with the business community to deliver on these measures. That would be one thing to deal with it. But now an expectation has been created in connection with the 24 measures. And again, it will add to the fatigue if businesses do not see these measures being implemented in a meaningful way. That sort of changes for the better conditions on the ground today.
Alicia, do you want to add anything here?
Yes, well, I mean, I really like Jens' point on this deviation, if I may say so, from what people expected, yeah? Jens mentioned the Davos, but we could go all the way to 2013 of the plenum which we're now waiting for again. But that was kind of this idea. Wow, Xi Jinping is going to be a reformist. The markets are present very strongly in the conclusions of the third plenum, and somehow we all thought. I mean, or we expected something that in a way hasn't really happened. Now, is it all because Xi Jinping gave, this impression that maybe also the world is different, I would say two things to me for the lack of action. One is the world is different. I mean, the US is very different, but also probably China's structural deceleration is faster than expected. Of course, one could argue this is exactly why they should do reforms, they should privatize it. Well, maybe, but, if you are scared of the consequences, if you have fewer resources, fiscal resources, etc., and you worry about what may happen in terms of the population disenchantment, maybe you don't do anything exactly because the situation is harder. Yeah. So this is, I think, the two reasons: the US and China's own deceleration beyond what was expected, lack of resources beyond what is expected. That brings us here. And I can't judge Xi Jinping. I'm afraid I don't know him well enough. I just read about him. So I don't know, whether he changed his view or he, quote unquote, tricked us into a different view. I'm just not able to.
Okay, so coming back to my last questions, should people still invest in China?
Yes, go ahead. I want to hear your view.
I think in many industries, and I mean, what we say now is that China is for many, but not for all. So I think you really, again, I mentioned before 5 different categories of companies, and I think you need to look at where in which one of these 5 and possibly more categories do you belong as a company. My own industry and many others, China will remain a critically important market, and it would be commercial suicide to not continue to invest and upgrade, because someone else will get into that space if you're not there, and you could be missing out on important developments. But there are also real concerns, and where maybe we have been a little bit complacent in the past in terms of discussing risk, being too focused on optimizing just-in-time processes, reducing inventories, drive down cost, and all these things that China, frankly, is world champion at. But we just have to realize we're living in a new world now, where there is a premium on resilience, and also being able to explain to your customers that you have a plan B, plan C, perhaps even a plan D. If you have another of these black swan events that are happening now with a regularity, so I don't even think we can call the black swan anymore. So it is, as Alicia said, it's a changing world, and we need to adapt to that. And part of it is that for some companies, it means that their sort of investment profile will also need to change.
Thank you, Jens. Alicia?
I don't think I can add, because this was a perfect answer. It is no answer, because it very much depends on who you are. I would imagine some companies have been designed to be in China, if you see what I mean, like literally. And therefore, asking those companies, should you invest in China, is a joke, because their whole strategy is China. And there's nothing wrong with that. But, there's many other realities. Yeah? Imagine that you are in, I don't know, a company that deals with security or, military issues. Well, that company might not want to be in China today. So there's extreme cases. And in between, you have everybody else, as Jens mentioned. So I don't think we can answer that question, like yes or no. The only thing I think I can say, and I finish here, is that for any of those companies, the trend, not whether they should or should not, the trend is harder. The evolution has become, I may say, worse in the sense that lower expectation of dividends or profits, and also a harder geopolitical, environment. So that's, I think that is easy to argue. But whether you should be there, you should not be there, I think every company is different.
Thank you very much both for this very interesting conversation. I think we can still discuss this every day. As you say, the situation is changing so fast. Maybe if we come back to this in a few months, there will be drastic changes to that. And thank you, Jens, for bringing up your wonderful survey about business confidence in China. For listeners, you can also find it in our show notes. Thank you so much for joining me today. I am Yuyun Zhang, and I am with Alicia Garcia Herrero, Senior Fellow here at Bruegel. I'm also with Jens Eskeland, President of European Union Chamber of Commerce in China. For listeners, you can find all our research on China at bruegel.org and sign up for our China podcast and newsletter with the link in the show notes. Until next time, bye-bye.